to these
We
numbers?
have a big problem here. So first of all, for the first time in my 30-year career as a business journalist, Americans are not spending all of what they have and then some. These numbers make no sense to me. I've got income up 1%. I got wages and salaries, I'm talking about December here, up 0.5 point, okay? I've got consumption down 0.5 point. So you people on set can all do the math of what happened. The savings rate, I don't know when this was last highest. I got the savings rate up to 7.6, and I don't believe it's been I believe it's been a very long time since I've seen a 7 handle on the savings rate. I don't believe these numbers. It's just not the way consumers are. They got more money in their pockets, they spend it unless they're deathly afraid of some sort of apocalypse happening tomorrow. And the personal income numbers for January down 1/10, wages still good, up 0.3. We do not have the consumption numbers. So did Rick tell us the inflation numbers in here? I think the other thing you want to know, and John Ryding, who's going to come up in a second, already pointed this out, these numbers are already in the GDP number, but this is just the breakdown. These are together with the consumption numbers we got in the GDP report. But they seem to be at odds with the GDP report, which shows strong spending. You want to introduce the guest? Maybe Ryding can make some sense about this.
Steve, thank you for
I'm going to look up when that was the record on savings.
Let's bring in both guests, Jason Trennert and John Ryding, join us. John, given this extra insight now, what was your take, or is your take, on the Q4 GDP?
The take on Q4 GDP is that it was strong. We should stop focusing just on the quarter-to-quarter numbers and look at the year-over-year gains. And if you look at that, GDP growth last year at 3.1% was the strongest since 2005. So the economy has been steadily picking up, and that's with these bad spending numbers. And I don't think anybody really believes that online sales fell in December, that retail sales fell 1.2%, which are what's embedded in these numbers. So the fourth quarter was probably stronger. So we have an economy that through last year picked up momentum. Can we grow sustainably at 3% plus? I'm not so sure, but there is, to me here, clear evidence that not only the actual growth rate of the economy, but the potential growth rate of the economy has picked up in the wake of the tax cuts of December 2017.
Jason, so we buy U.S. economic-linked stocks?
I do. I like cyclicals quite a bit. And I think, last year was a strange year because economic growth and earnings growth were better, and yet the best performing sectors were healthcare, consumer staples, and utilities. A lot of that happened in the fourth quarter. I'm very much of the view, like John, that first of all, I think I know for a fact that fiscal stimulus will be greater this year than it was last year. In my opinion, that's a false narrative. I also think that the market is largely not factored in the potential supply side impacts of the tax cuts. And I think to the extent to which perhaps trade recedes as an issue, business confidence could pick up, and you could have the capital spending boomlet that was really provided for, really created some incentives for in the tax cut that was passed at the end of 2017.
Well, I just want to get to the bottom of the consumer numbers with John over here. John, the consumption number in the GDP report was strong, 2.8, stronger than we expected, right? December retail sales were lousy, and now we see the December consumption number was lousy.
So what
happened?
We don't know what happened. I mean, we just got data. No, but we don't actually know. Not why it happened. We still don't know what happened. Remember, these data were collected. The government was under partial shutdown, so we don't know if that has messed up numbers. We're either going to see those retail sales numbers revised and an even stronger fourth quarter, or they're going to get measured in January. You don't believe consumers saved 7.6% of their income.
No, it's the highest number since, I think, 2016.
Remember, they don't measure savings as a number. They measure as a gap between income and spending. So the problem is we don't know what happened because spending was probably stronger.
So, John, could the Fed tighten again at some point this year, earlier than people currently expect after the pivot?
Well, the markets think the next move from the Fed might be a cut, which to me just makes very little sense in terms of fundamentals. I think the Fed will end up raising rates still twice this year, maybe once in June, because I think we're still set up. The Fed's guarding against all these downside risks, the cross currents they talked about, but the cross currents were the government shutdown, which is over, right? The cross currents were trade problems, which may be close to a resolution. We heard some very optimistic take on that from our former friend at CNBC, Larry Kudlow, who's now in Washington. Other cross current was Brexit. Well, Brexit may be kicked into 2019 from 2019 into 2020. So all the cross-currents disappearing and the economy is picking up steam. Yes, I think the Fed is going to have to adjust rates
Jason,
higher.
to the trade point, do you think that helps China as well and that global growth can surprise to the upside this year?
Well, I do. And that's mainly, it's not because of trade per se, but I think China is throwing everything but the kitchen sink at growth there. I mean, every 2 years, it looks like China's going to go through a hard landing. And then they dust off the playbook and they do the same thing, which is essentially spend money that they don't have, or they spend our money, and they create another Philadelphia that no one lives in, or they do dopey things with it. But the bottom line is I wouldn't fade Chinese economic growth this year. Stronger Chinese economic growth will help Europe. I do think, I would say with John, I would respectfully, debate. I think it's going to be hard for the Fed to tighten meaningfully this year. We have maybe one, but the hard part is if the rest of the world's central banks are mired close to zero, it gets tough for the Fed to get too far out ahead of the band
Jason,
without it creating other problems. It's
important to sort of think what is underlying John's argument, which is the same thing underlying yours, and that is growth is and will be stronger this year.
Yeah.
Right? I mean, John, you think the market, I think, essentially has this wrong, this slowdown.
Well, I don't see the slowdown yet. Now, I do expect the economy to slow a bit in 2020, but potential growth, right, the rate at which the economy can grow, maybe that's crept up to 2.5%, but we're growing more than a half point faster than that. That's going to keep pushing the employment rate down. So Jason said this, China's throwing everything, including the kitchen sink, into stimulating there. We have fiscal stimulus still coming through in the U.S. We have the Fed, which in December was still comfortable with 2 rate hikes this year, going to no rate hikes, I'm going to stop winding down the balance sheet soon. There is plenty of stimulus. And what will force the Fed to do it, Jason, eventually is going to be higher inflation numbers. And they'll resist that for a while ago. It's symmetrical, so we can let it run higher for a bit.
And underpinning this argument, guys, we have a participation rate in the back that we made for John here, is that prime age people are coming into the workforce.
Right.
And your point would be when that runs out, that's when you get to the old inflation.
But that's relatively new, though. So there's a little more. There may be a little more slack in the labor market than people had thought. And I would argue, John, my own opinion, is that there's really no risk in waiting because inflationary expectations, at least for the moment, are very well anchored. There's not a lot of and I just don't want to repeat what we did in December. I'd rather stay away from that and let it play out a little bit more. I don't think there's a lot of risk in waiting.
Jason, just quickly on a different topic I wanted to touch on. Given this better environment, do you think we see a big rush of those IPOs that have been on hold? And would you buy those, or do you think they're going to be?
This is a great question. The answer is you will see a rush of IPOs. The difference is that Amazon, as an example, went public at a $400 million valuation. Uber is going to go public at somewhere between $80 billion and $100 billion, if not more. So the answer is you're going to see the rush of IPOs. I would just be careful as an individual investor. You're not getting because companies are waiting so much longer in their life cycle, you're not getting the bargains that you were getting in the past.